All right, we did it. We are live here. Alexander Blum, the managing director of Two Prime. I'm excited to dive in with you and have a conversation today. Alex, for myself and people listening, can you just give a quick background as to what you're working on now and what you were working on previously?
Yeah, thanks for taking the time to speak, Mike. Right now, I'm the managing director of Two Prime. We are a hedge fund focused on risk managed exposure to digital assets. So basically, we use options trading strategies to take some of the risk and downside, big downside movements out of major investments in Bitcoin and Ethereum. So it's mostly an institutional structured product if you're familiar with that kind of terminology. And basically, we're using put protection to, when you have these historic, 70, 80% moves downwards in Bitcoin every 4 years or so, we want to experience a lot less of that for ourselves and for our investors. We just been managing our own funds since early part of 2020, which is really when the, Bitcoin was even options were even introduced through the CME, introduced Bitcoin options in January of 2020. Initially, we're running our own capital of about $40 million. And now, just as of February of this year, I've started rating outside funds and have about 100 million under management currently. I've been in the crypto space for a while. Initially, I bought Bitcoins for $9 in 2012. Not as many as I wish I would have. I've been doing various stuff in the space, venture funds, working at traditional hedge funds that had some exposure to this space as well. And then I've done consulting work for the World Economic Forum, the Gates Foundation, and then most recently, to actually answer your question, I was running an investment bank focused on providing both the compliance for investing into digital asset companies as well as actually raising funds on their behalf called Atomic Capital. And so basically myself and one of the investors in that fund, in that company, Atomic Capital, whose name is Mark Fleury, started this fund together, kind of looking at how do we keep our exposure to Bitcoin and Ethereum, but not have so much at risk all the time, because I'm pretty happy with how much money I have, and I'd like to have more, but I also don't want to lose what I have. Mark is a very interesting guy with a PhD in theoretical physics as well. And he previously started a company called JBoss that was acquired by Red Hat in 2006 for a few $100 million, one of the first kind of open source software companies with a successful acquisition. So it's the two of us plus our chief investment officer, Nathan Cox, who I've worked at in traditional VIX kind of volatility hedge funds in the public equity space, and kind of combined our forces to run Two Prime now.
Cool. Congrats on all the progress. Did it feel like a natural evolution? So you're sitting at Atomic Capital, you've got some investment background. It sounds like you did some cool stuff with the World Economic Forum and the Gates Foundation. Did it kind of just gradually turn into an opportunity that you're like, hey, this is cool, let me invite a couple of friends, and then you spin up a fund? Or was there more to it than that in terms of like the trajectory of things?
I'd say it's mostly by, like a lot of things, mostly defined by failure, like trying lots of things and then pulling out what actually works, which is, we were trying to do all this crazy stuff with kind of a coin that represented a closed-end fund and trying all these different kind of investment structures. And, thing that worked through all of that was we were just buying Bitcoin and Ethereum and managing the risk on it. And we kind of stripped away the rest. And this is actually what makes sense for ourselves and makes sense for outside people. And so I always have a tendency to want to like have complexity and novelty and everything, and be 7 steps ahead of anything based in reality. And it's you're kind of humbled by what people actually want and what reality wants, and settled on a pretty basic, what to me feels pretty basic in terms of where the market's at, and that's become this product.
Yeah. And so is it most people, do you think of most of the, I guess, consumers or LPs, not consumers, it'd be investors that you have in LPs, as they have some bank account, like I'd imagine it's in the multi-millions. They're more concerned about losing it than they are about making more of it. And so they give you guys this with the primary value proposition of don't lose a lot of it. Is that how it goes? Or do you guys think of the pitch differently?
Yeah, I think there's a couple categories of investors that we've added to the fund. One is people similar to myself or Mark who have held, crypto for a while, and they're starting to be like, hey, this is not a small part of my portfolio. I don't want it to be so subject to downside moves. Like, why don't I give it to somebody who can manage that for me? Either, people have sent us directly Bitcoin and Ethereum rather than, US dollars. So that's one category, is kind of the longer term holder. Another's been people like, like this Bitcoin thing doesn't seem to be going away. I need to get some kind of exposure. I don't know how to deal with private keys. I don't know what's going on in the space, but I accept that I need to have some kind of exposure to it, even if it's, a couple percent of my total portfolio. We have a couple actual corporate treasury clients who, there's all this talk about putting Bitcoin on your balance sheet, but our kind of position is like, yeah, put on your balance sheet, but why don't you protect it a little bit against major downside moves? So it's kind of a more responsible way to have that. We have a couple family offices that are investors. I think for, especially family offices never invest in the space. If you're a manager there, these jobs are so defined by risk. Like, no one gets mad at you for buying a bond and it returns 3%. They do get mad at you if you buy some shit nobody's ever heard of and then it goes down 70%. And so having some rails on the risk parameters through our fund helps some of those family offices get kind of initial exposure into the space as well. And then lastly, what's kind of surprised me is a couple venture capital funds who just have cash sitting. They might deploy it in 2 years from now, and they're saying, why don't I put this to work in some way rather than having it, slowly being eaten away by the price of inflation costs. So those are kind of the various buckets we've come across to date. Yeah.
Yeah. Yeah. It makes a lot of sense. I can relate, having been on the founder side, not having accumulated enough personally myself to have this problem, but we raised about 24 million for my last company, and we had that sitting in a SVB bank account. And I remember just thinking, like, God, this seems so kind of simple to just have cash sitting in the bank. But like, there's strangely not a huge incentive for at least startup founders to invest it in different areas, because it's like, okay, your value proposition is the company you're building. But even if you, like, for instance, my brother coincidentally raised 100 million this morning. His company is called Cameo. And he was telling me, he's like, yeah, we just have it sitting in the bank. And I'm like, man, it just surprises me that maybe there's an opportunity, and I'm sure there's people doing this, but to take like the vertical startup founders that have been on like series A, B, C, D, that have, 20 million plus. And like, I guess there's nothing wrong with keeping it in cash, and there's not a huge incentive to even grow it 5, 7, 10% per year. But it does seem like it's a risk when cash is when inflation starts to happen. Like, I wonder, I'm curious your thoughts on this. So the Federal Reserve, or the, Biden now and Trump previously, issued these massive stimulus packages. I literally got a $2,800 check in the mail a couple days ago, and I forgot this was even going on. And everyone gets it, and then it happens again and again and again. Eventually, there'll be a point where we really start to feel this slip of the US dollar. And I wonder, is that the catalyst for companies to invest in crypto bigger, where instead of thinking it as like, I want 3% of my portfolio to be in Bitcoin for the upside, do they think of it as a downside risk for the dollar? I don't know. Does that ring true at all? Or or is that just too...
That is, for, depending on the kind of company, there's, for like multinational, like shipping corporations that are dealing with 70 different currencies, there's always this currency risk. And then there's around the world inflation risk right now that surely is going to come to fruition at some point. I don't know if that'll be in 3 months or in 10 years, but a third of all the money that's ever been created, all the dollars that have ever been created in the last year, which is insane. And they're talking about creating more. Biden's putting another $3 trillion in infrastructure investments in the next coming months here. So yeah, if you look at the kind of historical behavior in terms of like correlation to equities or the dollar, Bitcoin is attractive because it is uncorrelated, or very, very little correlation to those things over its history. And so if you can think about it in a sizing perspective, how do I get I don't know if you're familiar with like in the investing world, there's this thing called the efficient frontier. So there's like a chart of here's the things in my portfolio and here's their return over time. And then the other factor is standard deviation. So it's like, how do I maximize my return and minimize the standard deviation? Meaning I can have a predictable return with the highest amount. And you can, statistically look at how much we do it with our fund, or, if I just had held Bitcoin, where would be the point of balancing historically, where I'd have the least deviation in my total return and the greatest return overall. And what you find is almost every portfolio, between 3 and 10% of it, if it had been in Bitcoin or, we do it with our fund, it would have done a lot better historically. And then on top of that, like all this money printing, it's interesting. Right now, a lot of the stimulus has gone directly to banks who are supposed to give it out as cheaper loans or invest in things. But so what you have is all these financial companies that have all of this new money, and so you see major inflation. I think first in equities, Bitcoin, things that are investable assets, because that's who has the money is investors. That might slowly trickle down into regular people. I don't know if you heard the term like Cantillon effects, but like basically, where money enters the system has a big bearing on who benefits from it and where that shows up in the price of things. And so, if I send all my money to farmers, like you're going to see the cost of farming equipment inflate first. We tend to send all of our money to banks or financial entities first from the government. And so that's where prices are inflated. But, when you send $1,400 checks to everybody, then it's a little bit more in the hands of regular people. And so you'll probably see consumer prices inflate shortly thereafter. And like, I don't know, if you look at the price of lumber or certain precious metals, there's such a weird inequity in where inflation's happening, but it's happening undeniably. I don't know if you're familiar with like Michael Burry from The Big Short. But his thing now is like inflation is coming and like, you better prepare for it. Bitcoin, obviously with finite supply, and Ethereum with a pretty tight inflation regime as well, are both well poised to take advantage of inflating environments. It's just the more money printed, the more money there is to buy the same amount of Bitcoin. And so you'd expect the price to go up. And even interesting, even this week is as markets are down, Bitcoin and Ethereum continue to move upwards. Same with gold is down today a couple percent and Bitcoin's up 5%. And so I think you'll also see this decorrelating between Bitcoin and even gold or equities over time, because it has unique characteristics in the way it's structured.
Yeah. I like that. Wow, those some good, what'd you call those? Like just thought examples or case studies, heuristics. I like that. I had never thought about it that way. Like the way the entry point for money is largely what dictates the impact across the economy in a time sequence. Yeah, the farmer example. Yeah, it seems like if we're going to ever print money and just give it out to people, that giving it out to people directly is the best option. I've swapped back and forth on universal basic income. At one point, I was like, "Oh, this is it. This is definitely the answer." And then time goes by, and I'm like, "I don't know, man. It just doesn't." To me, I'm like, well, on one hand, if we don't do universal basic income at all, the prices of things are going to naturally decline as technology progresses. So if we think that technology is stealing our jobs in particular is the rhetoric that gets thrown around, well, technology would make things so cheap that you wouldn't need more money than you currently have, because it's not a fixed supply. It's like something being delivered to my house via a drone manufactured in a warehouse with no humans. Like it takes no human capital to make that thing. So I hear both sides of it. I don't know. Are you a UBI fan, or have you made a decision on where you stand with regard to that?
I definitely think it's interesting. I think it's such a divergence from, in a certain sense with these stimulus checks, which continue, I think can likely continue. We're sort of have a soft version of that being implemented already. I think like Andrew Yang, like it's undeniable that automation and technology are going to eliminate a lot of jobs and going to reduce the cost to procure certain services and resources. I do think, to me, the question is like not, like the reason like a bank does well is because they give a loan and then they earn back more value than the loan costs, right? So it's like I give money for you to buy a house. The house both goes up in value and I'm earning interest on it. And so I think with all these like stimulus bills, it's really a question of not like, if we did UBI and everyone bought crack with it, then like it's not going to work out well. But it really depends on where that money gets allocated to. And I think that's the big unknown is like if you give everyone's like has no jobs, things are cheaper, and you give them whatever $5,000 a month, like what do they actually do? And I think that's a social experiment that hasn't ever really been done. And I think it's because of tech and automation, like the first time in history where we're facing this kind of issue where there's or like Marx would like differentiate between work and labor. And so it's like, okay, we're really reducing the time of labor that we need to have. But our people, like I know for me, if you give me all the time in the day, I would like to think I would like sit down and create art and like write novels, but that's not what I do. I watch YouTube videos and like take naps. And so I'm not saying like we need people to be desperate for money to like keep things going, but I just think it's a really complex question ultimately of human nature. I don't know. What do you think?
Yeah. I think you're spot on. I think there seems to be, in my firsthand experience, an accelerator, something where I'm like, oh, there's this great example psychologists would run on mice. So they would take mice inside of a straight line, like a straight tunnel, and they would put first they would take the mice and they put cheese at the end, and they measure the time the mice took to get the cheese. Then they would starve the mice for a week or so, and then of course the mice would run faster when it had the cheese. But the fastest mouse was the one where they sprayed cat urine behind the mouse, and they starved the mouse, so it was both accelerated from the cat urine to not get eaten and also really hungry for the cheese. And I think there's something to that psychological effect of like, I feel motivated to build something, to create value, to reap the rewards of it, but I'm also motivated to help other people. So it's like the cheese and the cat urine both together seem to be the balance. You have to have the push from behind and the pull from the front. And I think if you lose one of those, if you lose the cheese, we fall into despair, depression. We're stagnant. And if you lose the threat from behind, you get soft, right? This is like you're sitting around and writing literature, watching YouTube videos all day, and there's not actual progress. So I think progress seems like it's almost like the thing to optimize in society. The hard part's what is progress? What is it? What does it actually look like, and how is it distributed?
Yeah, I think there's a lot there. Like I don't know if you remember like Daniel Kahneman or like behavioral economics, but people are way, it's studied and proven like people are way more motivated by risk avoidance than they are by like opportunity or positive things. Like it makes sense. Obviously, like if we're being chased by a lion, it's better to be paranoid we're going to get eaten by a lion and be wrong than be calm about it and be wrong. And so, I think we're predisposed to avoid risk. The same, I vaguely remember like reading studies that like, if you tell someone they're going to lose $1,000 rather than like not make $1,000, there's very different behavior. People don't like to lose things. Or like if a company does something bad, most people will tell like 10 people about it, but if they do something great, on average, they'll tell one. And so I just think we're more oriented survivalistically around negative behaviors, and that shows up in the way we make financial decisions, the way we are motivated day to day. We're just big mice ourselves. I think also, I forgot what I was going to say, but I don't know what the right balance.
It almost feels like it. Yeah, it almost feels like when that functioning breaks down, then you have something like an addiction to gambling, where it's almost I'm losing money constantly, hoping that one day I'll make it. It's almost like the inverse of what you sell. It's like you sell the value proposition if you're not going to lose a lot of money one day, and you'll slowly make it over time. And that feels like a healthy cognitive function to have for most people. And so I imagine your target clientele would never be people addicted to gambling, because it's just like the opposite kind of thing. And I also wonder about these, like I've read about Daniel Kahneman and this study, and I wonder if we're in a time right now where we are a function of our environment, a product of our ancestors effectively. I think the cultural cognitive impact of World War II was so insanely large and undervalued, underappreciated today. Like I'm 33. My grandfather was in the war. He had friends who died. Yours probably is. Just about everyone's around us are not more than two generations from people who are incredibly traumatized by downside and depression. And I think that that still rides on our subconscious, and people are really kind of scared to lose stuff because they know, hey, this could be really bad. And I wonder if we're kind of, I bet it was different around the time in the Renaissance or times when things were pretty good, where like your creative mind just shoots. So, it's just like, I would love to get universal basic income, to sit around and write and art and dance and whatever else. But you have to not be traumatized in order to do that. Otherwise, you'll chase the YouTube videos and the numbing effect of drugs and other things.
Yeah. I think it's even like, we deal with a lot of high net worth individuals, and even just that, forget generationally, just now and today, there's, if you're living in, poverty, or you don't know how you're going to pay your next month, like next month's rent, like that's very different thinking than like, knowing I have enough money to live the rest of my life, pretty much doing whatever I want. And so I both make very different decisions. I think on a very different time scale, and I'm more inclined to like keeping what I have, not so much creating something wholly new, because I like the way things work. I'm, set up for today. And so I remember reading this book. I was in the Peace Corps years ago, and I read this book called Poor Economics, and it was kind of talking about why some of the economic decisions by the poor seem so irrational. Like, if you get $100, why would you spend that on candy and shiny things when you should be saving all your money? And it's like, in that case, they say, the odds of you ever getting to a point of enough savings where you can actually move out of your situation with so many like unexpected events that occur in the life of somebody living in poverty, it's futile. And so just people enjoy a couple minutes of joy rather than this fantasy of saving thousands of dollars. But I just think we really tend to assess like other people, even our present day, how they're thinking and how they're responding, obviously from our own shoes. And it's really different to think about that. The same, even in the crypto world, I think it's interesting. It's such a gambler's mindset. It's been such crazy returns. Obviously, it attracts a lot of people because of that, but the leading edge of it is high risk takers who don't have a lot to lose, because that's the only way to participate at first. And so it's very like our fund, which actually intends to make less return than Bitcoin on a raw return basis. That's a very specific type of person that within the crypto realm, people are asking, how do I do 3 times better than Bitcoin, 10 times better than Bitcoin? And Bitcoin is an insanely positive, like returning asset. And so it's just a different psychology and a different kind of group.
Yeah. There was a crypto company I started, worked on for 2 years called Redeem, and we allowed people to trade different cryptos with different alternative payment forms like gift cards or airline miles or just Venmo, that sort of thing. And we would get, this was in 2018, 2017. So we would attract people who were like, oh, I'm leveraged on Kraken, and then I bought it on Coinbase, and I leveraged on there, and I'm like 50x margin. It just boggled my mind. It put me in perspective to think I'm not actually high risk. There are people out there who are, willing to just crank up the dial and pull the slot machine. And yeah, you're right. It does feel like that makes sense if you have less. It's kind of like, I think the dynamics there are how many people are you taking into consideration for your decision, and then how far out are you considering? So if I'm poor, I'm going to make a decision for me in the moment. I'm going to buy candy, buy a lottery ticket, whatever it is. If I'm ultra wealthy, Warren Buffett style, I'm going to be concerned about the entire future of humanity from multiple generations down the line. Like you worked, actually, this is a good transition. You worked at the Bill Melinda Gates Foundation. They must be thinking about multi-generation global health. I'm curious how you view that project and what you did there specifically.
Yeah, so mostly work I worked on was as a consultant. I went to Tanzania in Africa and was looking at a project they were doing, helping farmers get a better return on their farming investment by providing loans and capital up front for them to farm and then teaching them more effective farming methods. And the part I brought me in to do was to look at how could we integrate, technology into this, so not everything was done on paper or manually on Excel. Could we use smartphones or tablets or other physical items, and could we use money in a more efficient way to like transfer capital or make it less friction, make it have less friction? And the short answer was like, yeah, you should do that. It would be better. But I think, the frustration with those big institutions, and why I'm more attracted to kind of doing private business and startups is, like they're thinking on this long time scale, but there's also, there's incredible amount of layers of bureaucracy, and there's also, a lot of money spent. And there's not, when you have so much capital at your hands, there's not the same, whether you want to be super efficient or not, like there's just not the same urgency to use every dollar intelligent than if you were like budgeting to get your groceries bought for the month. And so I think there's a just psychological difference there, kind of like what we're speaking to. But I think at the same time, there's a wisdom to the patience of it. Like, something might, in a startup, if it doesn't work for 2 weeks, you might pivot. Whereas some things, are just predisposed. Like if you're trying to change an education system or change a food system, that's a generational activity. And it's hard to make bets that take a generation to get accurate data about their outcomes. And so it's, the same, like the internet was largely developed by the government over, many, many years through DARPA, or which have a lot of investments that, like an individual may not make, but a large institution or a very wealthy group might make, and they have the patience to see it through. And if they lose the money, they're going to be okay either way. And so it's interesting to observe, but I guess I don't personally have so much patience where it's like, I just going to trust and have faith that maybe this will work. And if not, it's just my whole life that I wasted on it, so there's competing things there. And I think, both could benefit from learning a bit from the other.
Did you know a guy named Jack Langworth from Ninayo in Africa by chance?
No.
Yeah. Yeah, I only asked. He's a friend of mine. He's running an African startup that is helping farmers like financially purchase and exchange for maize. So I was like, there's got to be. And I know he talked to Bill Melinda Gates Foundation at some point. And one thing I would ask you about is, so running this fund, what's your day to day? On one level, I'd imagine you have the obvious, which would be conversations with your LPs, your investors. Probably reviewing the portfolio performances, tweaking the buttons here and there. But once you have that in place, is it highly active, or how do you sort of spend your time or think about spending your time?
Yeah. So, I think a couple things, varies day to day. For me, kind of the core thing right now that we're doing is just talking to new investors. So a lot of that's, getting on calls and just kind of explaining what we're doing and seeing if it fits for people, and building relationships kind of on usually like once a month. I'm in a different city. We host a dinner and get to know people. You mentioned Austin. I'm going to Austin in a couple days here. So there's some of that. And then, it's also taking really good care of the investors that we have. And so like, I don't want to have, this isn't like a retail consumer product. We have, just over 10 investors that are large investors. And I like that. Like, I like taking really good care of those people and like bringing them other investments that are outside of our scope, or answering questions for them, sending them interesting news articles that are relevant to them, and just having those kind of deeper relationships. And so some of that's, sending them a shirt or sending them a card or, whatever it may be, that just really invests in those relationships that we do have. Some of it's, just paperwork, like, we're dealing with lawyers and structuring the fund, things like that, making sure our taxes are done correctly. Making sure, our investors will have questions about onboarding and things like that. So not very glamorous, but administrative paperwork. And then, in terms of on the investment side, where our CIO and myself spend a good amount of time, is just kind of always looking for new statistics and new indicators, and continually improving their trading technology and infrastructure so that we can keep a pace. Because, one thing is like, whatever strategy you have, like it eventually other people catch on to it. It doesn't work the same, or the margins get worse, or whatever it may be. And so always just kind of keeping abreast of what's going on there. It's been really interesting in the like crypto derivatives markets. First of all, they're growing incredibly quickly. In 2020, the volume of options grew up 1,800% just over that year. And then they are about growing by 50% every month since then. So huge influx. And then also what's interesting is the behavior of those options positions, like how many people are buying puts and the complexity of the trades that we're seeing is changing a lot, which, if you're like a retail gambler, basically you buy calls and hope that the price goes up. If you're an institutional buyer, you tend to actually buy more protection and hope you hope it's just a waste of money on insurance, basically. And so we're seeing a greater influx of puts being purchased on these exchanges, and which tends to also affect the price of the underlying. Like just at the end of February, there was end of March, 6 billion in options expired. A lot more of it weighted towards puts than it historically had been, which depresses the price down. And then when those expire, you see these big pops up like we're seeing the last couple of days on Bitcoin. And so just kind of always keeping a pace of the way the market structure is behaving, and looking at whatever data we can find, on-chain data, off-chain data, how much exchange Bitcoin is available. Also always looking at the correlation between Bitcoin and Ethereum. They're typically pretty correlated, like 92%, but they're very different assets if you really understand what they do. And so we expect those things to diverge as they mature. And so looking at how that's behaving as well. So a lot of the endless kind of investment analysis as well. And then, just keeping track of, and I guess the main thing, that I'm starting to integrate more and more into myself that maybe you could relate to is having clarity and health for myself, where it's like, I don't have to make 1,000 stressful decisions every day. Maybe if I could just make 3 really important, really good decisions every day, and having the clarity to do that, which means taking care of myself, eating well, going to the gym, things like that. That's a part of it as well that I always felt was kind of like a vanity thing, earlier on, I need this massage or I can't do my job well. I'm not getting, daily massages or anything, but really understanding it's having some peace and clarity amongst such a fast moving market. That's really where we want to be differentiated. And it starts with me as an individual.
Yeah. Daily massages are a stretch goal. I think it's in some ways it's similar to, it reminds me of in golf. No one used to work out. People were largely overweight and in bad shape until Tiger Woods comes around, and then he gets ripped in the gym and just knocks out 450-foot yard drives and wins all the championships. And it's like, I hear you. I don't think enough people talk about that, but I think the intellectual gain you get from being in good shape, meditating, just having a peaceful mindset is hugely impactful. Like you can't, almost like the classic developers, overweight, playing World of Warcraft in his spare time, eating Cheetos. And we run at Otter Labs. I run a company called Otter Labs. We connect developers down in Argentina with startups in the US. And the vast majority of the developers that we meet now are like, their part-time hobbies are like going to CrossFit, doing jujitsu. They're sharp. I can kind of see it across the board that people there seems to be this correlation between high performer intellectual people and being in good shape. It's kind of just interesting to observe that trend. It seems like a good trend over time.
Yeah. And I think, if you have people like addicted to Adderall, drinking soda all day and like sitting around chain smoking, that on some level will get into things that are created. The mindset and culture of that is integrated into whatever gets created, the way it's marketed, communicated, the values implicit in that. And so I think that, I couldn't tell you exactly how like me meditating every day, how that gets absorbed into what we do, but I'm sure that it does over time. And that has compounding effects. And so, and it's just a better, I wake up every day feeling healthy and happy. And so even if it's all for naught other than that, like that's I'm happy with that trade-off regardless.
Yeah, totally. And you seem like just a well-composed, calm guy. You can meet people who are just like, they're vibrating. They're anxious about something. It's not the kind, especially in your position, it's not the kind of person I would give my life savings to manage it. And it's like, so I think there's something to be said for that. I want to ask you if you're open to it, a couple questions on just tools you use behind the scenes. I'm interested in what if there's a few specific tools that you use to gather data in the market on chain or off chain. Well, maybe we'll start there. Is there some that come to mind that you rely on or recommend?
Yeah. So, I mean, on like a just basic data level, a lot of good crypto data comes from skew.com, as well as Glassnode. Skew specifically has a lot of good data on the derivatives markets that we can pull from. Um, so in terms of data, there's that. And then there's, you know, we don't do this yet, but I'd like to, is you can run your own Bitcoin node instead of like trusting Glassnode for their data or whatever. They want to give it to you every minute, but maybe I want the data every second. I could just run my own Bitcoin node and get it. We're not there yet, but that's something I'd like us to move towards. And then, in terms of like trading tools, for institutional like derivatives trading on crypto, we just did a webinar with them, but this company called Paradigm, the paradigm.co is their website. And they are basically like a OTC messaging and derivatives trading platform that gives you better spreads on things. Trying to think what else. I mean, we have like our own, API connections to the exchanges that we use in order to just live pull data and keep track of all of our positions. And then we have, that's live fed into our own kind of custom software so that we can have a number of indicators like, we've moved 3 standard deviations over the last 24 hours. That's a pretty good signal. We're not going to keep moving upwards just statistically. So there's basic things like that. And then you can kind of build out the complexity of those indicators. I think right now things in crypto are so fluid and then are changing so quickly that like we don't really trust, especially in the options market, automating a lot of it at this point because nothing's really stable on even a week to week basis. And so we mostly use a lot, if 10 of our 12 indicators all say, buy or sell, that's a good influence on us. But ultimately we feel like there's a good degree of human judgment still needed in what we're doing, just because there's not enough data and not enough stability for anything to be really predictive at this point. And so, I don't know if that's,
and it's so there's so much more to it than just in the example of say, like, I mean, I guess every market is complex, but I'm thinking about say like copper or something, if you're a metals trader, you have like, you kind of have a creative constraint, a barrier around where you're investing. Whereas crypto seems to involve every government, every banking institute, the number of things that it impacts in the world just seem like, how could you ever quantitatively assess that with any rationale? Even looking previously, like when you were talking about earlier, looking back in time and calculating the precise deviation between returns and risk, it's like, how correlated is the past to the future? I don't know. It just seems probably not usually.
And there's a couple of things there. One is like, you could be right 99 times and just wrong once and the game could be over. It's like if you gamble and you like go on black and it's black 99 times in a row, you're rich until it's red one time and then you're out of money. And so, I think that mindset of like really just, it's never done and it only has to like deviate once for everything to get screwed keeps me alert, I would say. And then, I mean, that's why I find so much attraction in crypto, and it's kind of like an endless source of interest, is because there's such complexity to it. It's social, it's political, it's economic, it's cultural. And so how all those things all get combined into a single number, like the price of Bitcoin, I think that's interesting. That's what financial markets do, is they take all of this noise, all this real human experience, and make it into a single number. Like, do you want to buy it for this price or not? And who and why and when? And I think that's fascinating. There's kind of a fun in like, there's a subjective element and a very objective mathematical part that kind of has a union right there. That's really interesting to me. And then the other part that's, interesting in trading crypto as opposed to public things is, your most financial trading tools are used based on like linear trading, like things go up linearly or down linearly, or they revert to a mean. Bitcoin has this exponential movement in it. So it has some local linear behaviors like standard deviation predictions and mean reversion. But historically, every 4 years or so, you have a 10 to 20x rise in price. And so those are way different timescales and like risk behaviors, and trying to integrate those into a trading strategy is a pretty interesting challenge for us.
Yeah, that's really well put. Do you guys, is it only Bitcoin now, or what's the distribution of holdings?
We're about 50% Bitcoin, 50% Ethereum in the fund. We rebalance it on a quarterly basis, but because we trade options and we can protect a lot of the downside, my personal opinion is Ethereum has a lot more upside in it still, but also the potential to not exist still. And so it's kind of a risk reward there. But because we trade options on it, we can take the risk because we can limit exactly, to the number, how much we could possibly lose doing it. And so that one though, Bitcoin is like gold. Like there's no founder at the top of it. It's just almost like an institution. Ethereum is a company run by individuals and there's competitors to it. And so, it's more like in tech investment than it feels like, investing in a natural resource, which Bitcoin feels more like.
Yeah, that makes sense. I listened to a really good podcast with Tim Ferriss Symbology a few days ago. It just came out, and so much respect for this guy. And he was asked the question, Tim asked him the question, if you had $100 million today, how would you invest it? Or how would you recommend investing it, or just have people think about it? And he's like, he said your exact distribution. He's like, I would put 50% in Bitcoin, 50% in Ethereum. So you should send that article or that podcast to your investors, telling them you're onto this insight.
Sure.
How do you guys store the crypto? Are you using what's the word I'm looking for? Like a BitGo, or not BitGo? Custodian, yeah, there.
So all the capital that we have, it either is lent out to other third parties, like large hedge funds primarily, so we can earn interest on it. These are really well-known funds in the space with, tens of billions of dollars on their balance sheets. So we're pretty secure in the diligence we've done on them. Just so we can earn a little, it's better sitting there than just earning no yield on it. So it's really their custody, which I think in some cases at BitGo, or they have their own in-house custody systems. And then the crypto that we use for options trading sits on the exchanges that we use. And, those exchanges keep most of that with a custodian like BitGo, or in cold storage in some way, so that even if they're hacked, it's pretty limited up to, 10% max of how much is even available to be hacked. And so that's where the money sits. But, if it's just sitting in BitGo for us, it's basically, there's other places we could make more with it. And so we send it there.
Do you get into, and don't worry, I won't tell anyone in this. Do you get into like Nexo, or I like Nexo and Celsius are decentralized finance options that provide lending and borrowing. Do you guys use them through the fund?
So the short answer is no. We've talked to them a bunch of times. What a lot of those groups do, BlockFi also, is they take retail people, they take their 5 Bitcoin, and then they aggregate that and re-lend it out to my company or to the companies that we lend to at better rates for them. And so we just cut out that middleman and send it to the end user, and just do our own diligence on it and get those better rates for ourselves. But we've had, there's also, what's interesting right now in the crypto world is there's no shortage of people looking to lend Bitcoin or Ethereum. In fact, some groups don't want it. Like we wouldn't ever borrow Bitcoin. Like there's no shortage of it. Where there is a huge shortage is in US dollars or stable coins. Like you can get 10 to 12% interest lending the US dollar out. We're speaking to some, just private lenders of regular lending funds that are trying to figure out what's the real risk in lending to some of these crypto funds because the rates are so attractive. And that's kind of, the systemic risk is kind of what you were speaking to before, is these people using 50x, 100x leverage is insane. You have these little moves down and they're completely liquidated. And that's when you see these big moves down. That's what is happening, is this cascade of liquidations where you have a lot of retail people super leveraged. The price goes down a little bit, or, bigger institutions do a sell-off to instigate this whole sell-off. They have to sell off to liquidate their positions, which means the price goes down lower, which liquidates more positions. Then you have this 10, 20% move down in a single day. And it's because of super irresponsible lending behavior and this kind of gambling mindset, or I don't know, irresponsible, but high risk, let's say.
Yeah. High risk, yeah. And so I'm curious, what do you think drives the return? Say if I had stable coin like a Tether or something, and I'm getting 10, 11% returns through a retail option like Nexo or Celsius, what are they doing behind the hood? They're relending that out to larger hedge funds, and then they're doing what with it? Because interest rates are so low in the US. There's like, why? I just don't, it doesn't seem to add up. I don't see why anyone would not just get a cheaper rate.
Yeah. So, the best thing right now that a lot of people do is this like spot carry trade. So I'm not sure how familiar you are with like financial markets, but Bitcoin futures, like a month out, sell 1 to 2% above the current price. So I could buy a Bitcoin today, sell it for 2% more in a month, and there's absolutely no risk. And if I could do that every month, I can earn 15 to 25% just doing that trade with there's no risk. Like I've the whole position, I bought the Bitcoin, I've sold the exact same amount of Bitcoin for 2% more, and my position is done. So there are a lot of institutions doing that trade. So if I can get it, I can pretty predictably make 20, 25% doing that trade, at least for now. It'll go away and get compressed over time. But yeah, I'll borrow money at 10%, sure, because it's literally a risk-free trade. And that's a lot of groups ask us if we do that, which is not really worth our time on a day-to-day basis compared to other stuff we're doing. But that's where a lot of the money's going today. And then I think the other, major aspect, which is the advantage in crypto, if you understand it, is, regular people just don't understand how any of it works. It just seems, like another word for risk is just information I don't have or something I don't understand. And so that is different for different people. If don't understand how a blockchain works or how the halving cycle in Bitcoin works, it seems like crazy behavior. But if you do, then it's a different risk profile. And so for those that lend money, it just seems higher risk. And so they're not willing to lend at reasonable rates. So it just pushes the rate up all across the board.
Yeah, it's a good explanation. It's almost like the way to think about it is the high rate of return for the interest on stablecoin is powered by the limited supply of Bitcoin in the market, and the high confidence that people have that Bitcoin is going to be higher in the future. Maybe push out fiat and become like a central currency that we all use. That seems like it's a fairly likely at some point in the future. Yeah, it's interesting. And do you guys or do you think about like running these trades frequently? I guess one other thing I wanted to ask you is what do you think if there's a Nassim Taleb black swan event in the crypto space? What do you think triggers that? We saw India recently said that they're punishing people who even own Bitcoin. That seemed to have some effect, but it certainly wasn't monstrous. India's a large country. I don't see the U.S. I mean, government regulation maybe has some, short term, but it's not like a black swan effect. Like, I don't know, solar flares or something like that. Is there anything that you ponder about that you're kind of existentially concerned about?
Not really. I mean, I think historically Bitcoin will do these 10, 20x moves up and then revert 70 to 80%, which I don't know if it's a black swan, if it happens periodically on a predictable cycle. We expect that to happen. I mean, I don't know how familiar with the Bitcoin like halving cycle, but roughly every 4 years, or specifically every 210,000 mined blocks of Bitcoin, the rate of production of new Bitcoin is cut in half, and so your reward for being a Bitcoin miner is cut in half. And it tends to be the first 14 to 18 months after that is when you see these exponential moves up. Right now, we're 10 months into that cycle since the last cut, and almost exactly on schedule. We've seen the moves start to begin. Right now, we're tracing somewhere between the last two cycles, which is a 20x move and a 12x move. We're somewhere around a 16x from the last previous all-time high. And so I think what happens is, one, you have this cut in supply, and so there's just less available to be bought. You have the rise in price, which gets a lot of people excited. They want to buy on it, and it becomes sort of a local bubble, or I think about it as waves. Like it's a bubble, but it's not permanently burst. It's riding upwards over time. And then because Bitcoin, unlike a lot of financial products that are limited to a specific jurisdiction or limited to a specific class of investor, like accrediteds, you have this ability for retail mass buying and FOMO to flourish. And then it goes up, you have this crazy leverage and risk taking and this kind of euphoria, and then it pops and everyone tells you it's dead, and then it kind of starts over. So I've been through, that cycle. This will be the third time I'm kind of gone through that as an actual owner of Bitcoin, and it becomes actually sort of comfortingly predictable. So it's not really a black swan event. We expect it to happen in our fund. The whole thesis of our fund is that will happen, and we are going to not ride it down along with everybody else because we expect it to happen. So yeah, I don't, I think and then
that's a good answer.
One open question.
It almost reminds me.
Like, you have these institutions making major positions in Bitcoin, and they're not going to get scared. They're not going to sell off when they're expecting it. They're aware of these cycles. Same with Tesla, these groups, this isn't their life savings. It's small fractions of their whole asset base. And so, you might not see the same degree of ride back down, because like Michael Saylor of MicroStrategy, who's been buying billions for his company, like, they're not selling. Like, they've bought in at 40, 50, 60,000. They're going to hold it. And so you creates a kind of a new floor that's maybe a little bit robust. We don't know how high Bitcoin's going to go to know how far from the top that floor is right now. But I think you might start to see less volatility, a little bit smoother buying behavior over time, as well as the rise of the derivatives markets kind of take out some of that downside risk and smooth that curve. And historically, we've seen the realized volatility of Bitcoin diminish over time, but it's still pretty significant.
Yeah. Well thought out, man. I can tell you think a lot about this and read a lot, which I really appreciate and enjoy talking to you. Is there anything that you want to send out there into the world? Anything that would help you, or things you're looking for? Investors,
our website is 2prime, TWOprime.io. And our Twitter is 2_prime. And you can get in touch with us there. We're always looking to speak with kind of mindful and intelligent investors. So that's kind of the goal. And always open to new ideas and new people.
Yeah, that's awesome. And do you do any writing or posting or writing down your thoughts anywhere?
Not as much recently as I would have liked. I've written stuff for Forbes, and we write blog posts on our website and stuff, but right now, not much. But you're making me think maybe it'd be nice to get back.
You should. Well, we'll have to do the show again at some point. I really enjoyed it. And where can people reach you? Are you Twitter accessible?
Yeah, Twitter. My email is alexander.blum@2prime.fund.
Awesome. Well, Alex, it was a real pleasure chatting with you, man. And congrats on all the progress, and wish you the best.
Yeah. Likewise. Thank you.